Welcome back, everybody, to 15 Minutes of Finance. I'm Brandon West, a CPA, and I'm going to help you keep more of your money. Today's episode is sort of a small business tax primer, okay? So this is designed to help you save money on your taxes, to grow wealth through your business, and this is for anybody from a very, very part-time contractor who got a 1099 for a couple odd jobs to someone fully entrepreneurial, paying bills and living off of the income of their small business, okay? Because you'll find that tax-wise, there's not really a difference. If you get income outside of a W-2 for performing a service, you're a small business owner. So you're catapulted into it, whether you like it or not, and knowing the tax tips and strategies of small business owners is going to help you a ton. So let's talk about it. There is a ton to talk about. 15 minutes for the sort of tax advice for small businesses is quite the ask. So we're going to get into it and talk about a lot of the overarching strategies, as well as some nuance and some tips for the small business owners listening to this. As a little bit of background for those who don't know a lot about our practice, I'm a CPA partner with James here at our firm. He handles all the wealth management. I handle all the tax and accounting services. Primarily on the accounting and tax side, our practice is small business owners. So I would consider myself a small business expert in the tax field, and these advices, these tips are brought to you from a place of experience, learning often the pitfalls I've seen clients fall into, the ways that I've helped them, and some ways that I wish I could have helped them, and things that they've done maybe in the past that were not advantageous, where they maybe missed out on certain tax strategies or certain wealth building strategies. And so hopefully you can listen to this and you can avoid those pitfalls. So that's my background talking about this. I love working with small business owners. It's primarily what I do in my practice. When we go and we market and we advertise our tax services, we go to small business shows because those are the clients we love working with. It's just sort of a passion point of mine as an entrepreneur, and I love working with those type of business owners. So first of all, let's talk about the structure of your business, okay? So if you have started a side business and it's really profitable at all, you've probably already heard the term S corporation, okay, or an S corp. You should start your company as an S corp. That's common advice. It's often very good advice, but I don't think a lot of people really understand why if they're not in this tax space, okay? So why would somebody be telling you to be an S corp as opposed to an LLC, a partnership, a sole proprietorship, whatever, right? So all of those other forms of business that I just mentioned. Sole proprietorship, meaning it's just you. Oftentimes people just have their social as their primary number. It's just them working as a contractor. Some people do apply for an EIN, an employer identification number, or they apply for a DBA name, a doing business as name, to kind of differentiate the brand a little bit from them as an individual. But a sole proprietorship means it's just you. There's no formal business entity. And then an LLC or a partnership, you have to register with the state that you're in. All of those things tax-wise are the same. Partnership, LLC, a sole proprietorship, they're all going to be taxed as self-employment income, which makes sense, right? You're self-employed. You're working for yourself, whether you're a partner in a partnership or LLC, or you're a sole proprietorship, you're an entrepreneur working for yourself, right? There's no separate business entity. You're not getting a W-2 from any sort of company that you're working with, okay? Well, what that means in taxes is if you're usually used to getting a W-2 at your job, you know that there's taxes withheld. You're like, oh yeah, this is how much I make after taxes, right? And you don't really think about it. You just know that it's a way of life for any employee out there. Now there's income taxes being withheld for you based on an estimate of how much you think they owe, but there's also employment taxes. Mainly that's Social Security and Medicare, okay? So those taxes that make up employment taxes are another big element of your tax situation. And usually those are withheld for you and you pay half. And your employer pays half, okay? So it's about 15.3%, so it's like 7.65%-ish that you're withholding and your employer is paying. Well, you're self-employed now, so you're paying both halves. So that's the number one tax situation that small business owners try to avoid is, well, if I make $130,000, let's say, of income after expenses, 15.3% of, six figures is a lot of money, and you're trying to save some of those earnings and not pay as much in taxes. So sole proprietors, LLCs, partnership owners, those individuals are all paying self-employment tax on their earnings through that business. So how is an S Corp different from this? Let's start with the fact that an S Corporation is not a type of business entity. You file either an LLC or a partnership, or you file a C corporation, like a standard stock corporation. And then you follow that up to the IRS with a form numbered 2553, election by a small business corporation, or election to be taxed as an S corporation by a small business, or it's something like that. Form 2553 that elects taxation as an S corporation. So it is a tax status. It's not a type of business. So if you hear people say you should start an S corp, what they're saying is you should start an LLC and then you should apply to be taxed as an S corp. So we're talking about tax savings here, not organizational structure. What the tax saving allows you to do is now there are two separate entities in terms of employment. There is the corporation, and then there's you as now an employee of that S corporation. So you have to now, if you're withdrawing money from the business, you have to pay yourself a fair and reasonable salary. So let's say you made that $130,000 or whatever number I said before, and now a reasonable salary for, a photographer, let's say in your area, you're a photographer, is $75,000 a year. So you pay yourself a $75,000 salary. Well, now there's $65,000 of net business income no longer subject to self-employment taxes. That is a massive tax savings, okay? So let me reiterate, what an S Corp allows you to do is the business income up and above the wages that you make are not seen as employment income. They're just seen as ordinary income. They're business income and they get taxed as ordinary income. So you're not paying self-employment taxes on all of those earnings. So in this case, you saved $65,000 worth of income being subject to self-employment taxes in addition to income taxes. And what that saved you is about $9,945. So with no change in income or expense write-offs, by structuring your business tax-wise as an S corporation, you saved just short of $10,000 just because now there's a separation of the business's income versus your wages as the employee, okay? We're going to use this opportunity to transition, but to a very similar topic, and that is tax savings are not the only reason to have wages. Okay, well, let's call it. That was the least smooth sentence I've ever said. So tax savings are not the only reason you want to consider recognizing wages for yourself. I'm going to walk you through a personal example. Me and my wife started an escape room company, okay? We opened, I believe it was August 3rd of 2019, okay? That's when we opened our company. We were an LLC with a couple other owners. Hadn't applied for S Corp taxation yet, and that was intentional. I was a CPA even before doing that. We had a couple other owners. We knew we were going to be reporting losses, so we thought, well, there's no tax savings yet because we're not going to pay ourselves a salary anyways, so we're going to hold off, and we ended up being an S Corp a couple years later. Well, here's something non-tax-wise that threw a major wrench in our plan. If you're following and you're aware of recent global events, you can take a little bit of a guess of what world event impacted a small escape room company, and that's the COVID epidemic, right? So now you had our business completely shut down, and here's where this came to bite us. When we're applying for loans or PPP relief money or small business grants, a lot of those things are asking for wages, right? PPP loans were designed to retain employees. Well, there were no employees. We were just working as owners of the company. So we got $0 of PPP funding. There's other things too. Oftentimes you have to show wages to apply for either a business loan or a home loan. So those of you who are looking to buy a house, if you're an entrepreneur, you have to understand that banks view business earnings as far less stable proof of income as they do W-2 wages, because if you just print out your QuickBooks, you could alter that pretty easily. It's hard for them to audit it. Businesses, entrepreneurial efforts, they go up and down, they fluctuate a lot, so it's hard for a bank to approve a low interest rate on a large home purchase for someone who only has small business income. But if you have been an employee of your own business and you have a W-2 that shows you made $100,000, $90,000, whatever, you have much more substantiated earnings. Okay, so showing wages is a huge benefit. It can be in the long run, so that you can legitimize the stability of your income. And the list goes on for how this can benefit you. Later on, we were on the right side of this. So a couple years into owning our escape room, we now go for S corporation status. The business is a little bit more successful. The lockdowns are done. We're growing. Okay, we're going to be able to start paying ourselves, a moderate salary as the managers of this escape room. Then, a total of maybe, I want to say my timeline, it's about 5 years after we first opened this business, my wife's pregnant, right, with our first child. So she, when she's 36 months pregnant, goes on maternity leave through California. I also take paternity leave when the son is born, okay? All of those applications for those relief programs, the amount we got was a direct percentage of the wages reported, because they use your taxes, for example, your unemployment taxes withheld from your paychecks here in California. Other states have very similar systems, but it's, I believe, FUTA and SUTA, federal unemployment tax and something, I don't remember exactly what every letter is for, and then SUTA, state unemployment taxes. Okay, so those payroll reports that your employer, which in this case is your own business, has reported directly affect the relief benefits that you get. So a lot of people, and I give this advice to everybody, well, when should I apply to be taxed as an S Corp? Well, tax-wise, it is when your business income exceeds what you would reasonably pay yourself as a salary, because now you're going to save on taxes, right? If you only make 30 grand, you're not going to be able to justify that a photographer in California makes 10 grand, right? So you can't pay yourself a $10,000 salary and now you avoided payroll tax on $20,000. If you get audited, that's going to be seen as fraudulent avoidance of payroll taxes, and you're going to get heavily penalized for that. So you can't justify that. But if you're making 150 and a photographer realistically makes between 60 and 80, depending on your area, now there's a big gap there. There's a lot of income that you want to shelter from self-employment taxes. So that's the conventional wisdom you're almost always going to get from a CPA. But I'm here to tell you that there are other levels to this. It's not just a tax equation. If you make $85,000 and reasonably, photographer in your area makes no less than $80,000. So we're talking about $5,000 that maybe wouldn't be subject to self-employment taxes. Well, between the moderate cost of a payroll software that you're going to have to run for yourself, you're probably going to pay a CPA a little bit more money to file an S corporation business tax return for you, a corporate tax return, than you've been paying them to file your 1040. So there's that cost to it. A lot of CPAs have $1,500, $2,000 minimum for a corporate return. Okay, that's pretty standard. So you're like, oh, well, now there's $2,000. Now it's actually going to cost me more money because I'm only saving 15.3% of $5,000, but it's costing me $2,500 between filing fees, software fees, all these other things, right? It could still be advantageous of you to do that, so that you can show wages. If you're a mother or a father expecting a child, if you expect to apply for business loans, if you think you're going to buy a home in the next 2 to 3 years, you're going to want to establish payment history in wages to justify all of these things. Okay, so that's a huge one I see. We'll call it sort of the misconception of the S corporation, which is that it is only a tax decision. But there are a lot of economic factors that rely on the choice of, are you going to separate yourself as an employee who makes wages from the business earnings that your business earns? Because again, sole proprietorship, LLC, partnership, all of those entity types, they're all reporting income, not as wages, but as self-employment income. And it could affect your qualification for a lot of different things down the road. Okay, so we'll probably do a part 2 next week as we continue to kind of dive into tax time and the type of things that entrepreneurs should be writing off. So these are some of the big things structurally. We'll get a little bit more into the nuance next week. So we'll call this part 1 of the small business tax primer. And next week, we'll delve into a lot more of the expenses to write off. Once you've made the determination, what type of entity should you be? Are you structured the right way? Are you doing things correctly? Now let's look at how to maximize your tax deduction so that you can pay as little in taxes as possible on that business income, regardless of the type of structure that you create for your business. Again, as always, thank you so much for listening to another episode of 15 Minutes of Finance. We love having you. You can always reach out to us for any topics that you want to hear covered. I know Spotify allows the options to leave comments on videos. That's a great way. Leave a comment, say, hey, I'd love to hear you answer this question. Videos coming very soon. As always, please share this podcast with anybody who could benefit from financial and tax knowledge, anybody who's interested in this type of thing and could use some help on their finances and on some tax strategies for their own situation. As always, invest early, invest often. We'll see you next time.